In a week that's dominated by central banks, we've already seen the Bank of Japan with a hawkish hold, and with the FOMC, the Bank of Canada, the ECB, and the Bank of England all yet to come. I think it's likely we're going to see a similar kind of theme come to the fore, with a view of a pause, but the likeliness of a tilt towards the upside in terms of expectations for where rates are going to go from here. And so within this video, we're going to be taking a particular look at things from a European perspective, with Wednesday's FOMC and BoC meeting leading us into Thursday's European events, which sees the ECB and the Bank of England take centre stage. And so kicking off here, we have the outlook in terms of things from an economic calendar perspective. By and large, markets expecting both banks to retain rates at the levels they already are, but you can see there's a significant differential when it comes to how much easing both banks have done thus far. 3.75 for the Bank of England, 2.15 for the interest rate for the ECB. And so bearing in mind, by and large, they're starting from a different point. That could make a difference when it comes to interest rate differentials and the outlook from the FX perspective. Notably, when you're looking at the outlook in terms of the votes for the Bank of England that we've got here, there's a view that we're going to see 0 to 9. Essentially, markets expect that everyone's going to vote for a pause this time around. Will that be the case? Well, certainly we saw a Bank of Japan meeting that saw 3 of the 9 members voting for a hike. And so whilst the volatility this time around is not going to come from the decision to hike or not, because by and large it's pretty much factored in that we won't see anything, it's that kind of event that could move the markets in terms of a significant number of the members voting for a hike at this meeting. So that's certainly something you want to be looking out for. Comparing the two, according to monthly inflation metrics, CPI this is, you can see that the past couple of months have seen oversized gains. Notably, the February reading doesn't even start to take into account what's happening in Iran. So we already saw elevated figures, but by and large, it sort of counteracted the downside move that we saw in January, which is often the case, right? You come off the back of the December period where you see everyone sort of stacking up their purchases for Christmas, and then January, you see the January sales and people are desperately trying to keep people spending. And then February, we saw a significant uptick as that period of sales essentially ends. Well, March saw a sharp move towards the upside, most notably for the Eurozone. But then we, of course, soon enough see the April readings coming into play, and those elevated energy prices in particular really pushing inflation higher. Now, the key thing here is we've seen it in terms of the forecast adjustments from the Bank of Japan. Stagflation is a big concern, which means that they're worried about a rise in terms of inflation. That's something that we've seen in terms of the forecast from the BOJ. They lifted inflation forecasts going forward, but they moved the growth forecasts lower. And so the job of a central bank is primarily, generally, to keep inflation under control. But many will also have a secondary remit, and that is to manage the jobs market or to keep growth steady and on target. And so certainly they will be bearing in mind the idea that if they start to raise rates, it's going to be stifling an economy that's likely to be suffering anyway, owing to, for some countries like the UK, policies from the government which stifle business, but also the fact that we're seeing potential shortages in terms of fuel and helium and other products, but also higher prices. So higher input prices for businesses and consumers, so less consumption, likely because they're spending more of their money on fuel and they have less money to spend after that. So economies that are already struggling, to hike rates into that is not ideal, to say the least. But that's potentially what we're going to have to see. Now, if you look at the last 6 months on an annualized basis, the biggest swing has come from the Eurozone, because we had seen the Eurozone on track to start moving into really low levels of inflation, because over the course of the past year, we had seen very minimal inflation from the Eurozone. But things have swung very sharply because of those two monthly metrics on the February and the March numbers. That 6-month annualized figure has grown significantly. In terms of the outlook from the ING, I thought this was a good way to sort of round up the potential things that could happen, but the likely things that will happen according to it. So we've got their inflation and growth outlooks, and the base case ING are pointed towards is too early for conclusion, balance of risks in terms of growth. And this really highlights the fact that right now, the job of the central bank is quite difficult from the perspective of actually taking a viewpoint from one side or the other, because, of course, we don't necessarily know how long this crisis is going to play out in Iran. What we do know is that whereas Donald Trump, when it first started, said this is going to take 4 to 5 weeks, it's now 2 months. And the idea that we're going to see an agreement immediately seems somewhat foolhardy. We don't really appear to be anywhere near an agreement. And the feeling is right now that the Iranians are quite happy to elongate this, especially as energy prices rise, because that puts more pressure on Trump to strike a deal. And the Iranians just have to sit there and try and pretend they're negotiating. Now, there's a lot of talk about potential shut-ins. Donald Trump said that the Iranian oil and gas facilities are going to explode if they don't make a deal within days. I think that's unlikely, quite frankly. There's talk of them having another 2 to 3 weeks of storage before they have to start shutting things in. I don't necessarily think they're going to strike a deal immediately. And so bringing it back to the viewpoint from a central bank perspective, the idea is that these central banks don't necessarily know what the outcome is of this current shock. But there is a knowledge that it will bring inflation over the near term. You don't know how long that inflation is going to last for. You don't know whether we're going to see that come collapsing down. Our energy price is going to immediately drop back down to $70, $80 a barrel as soon as we see a resolution to this. Or will it take things to get back to normal in terms of deliveries, which could be a month later? Or will it not get back anywhere near those levels because of the fact that we've seen significant damage done to facilities in the Middle East and alike, and in which case it's a higher for longer. So there's a number of different things that the central banks don't necessarily know. They can try and guess it, but essentially when it comes to these meetings, coming in and saying, I've guessed that it's going to do this or that, means that you're likely to see a relatively mixed outlook from the group. And you're probably not going to get this consensus over the need to hike or cut. And bear in mind, many central banks are focusing on core inflation, not headline inflation. So that will strip out much of the impact of the energy prices over the near term. So, of course, we've got the core PC price index over in the US, most notably. So that's another thing to bear in mind. And certainly something we're going to be focusing on is, what's the outlook from the bank? Do they feel that the current rise in terms of inflation is the kind of inflation that they need to take action to thwart, given the fact that their actions aren't going to really adjust how much the cost of oil is and how much inflation is if it's driven by energy? So some would say this is something that they should be looking beyond, because it's not something that's going to be impacted by interest rates and by monetary policy. But energy prices will permeate throughout the economy. So no doubt, as they feed into input prices, people will, or companies will, start to raise prices themselves. So inflation goes up. And if people have additional cash on hand, which is impacted by interest rates, then they might pay those higher prices. And that doesn't necessarily put businesses off charging higher prices. So they might view it from that perspective. In terms of the outlook for what the bank are going to do, the ING are pointed towards a hold, cautious but hawkish tone. And this really highlights the hawkish hold theory that I think is pretty likely here. I mean, this is likely to be the story from all the central banks, because as you've got inflation rising, but uncertainty over exactly how it's going to play out, the idea is they're probably all going to hold, and they're all probably going to say that there's a good possibility that if we continue to move in this direction, they're going to have to try to take actions to bring down inflation, which means they'd need to raise interest rates, which is the hawkish side of it. One thing I thought is notable over the course of the past month is the outperformance of the Australian dollar from an FX perspective. Of course, where we're looking at here is you've got the US dollar, which is flat essentially. So the comparative is against the US dollar here. So when we're looking at the price action for, say, the euro and the pound, it's somewhere in the middle. The reason why we've seen the Aussie dollar doing so well is they've already hiked rates, and inflation is very clearly a problem over there, and they have major shortages. So that really signals the sensitivity that you're going to see for the likes of the euro and the pound around these meetings in particular, but also around those inflation readings. Notably, European gas prices, you're going to see a relatively similar trajectory for gas prices throughout the region. But certainly the UK has been signaled as by the IMF as one of the worst performing countries when it comes to growth and inflation. So the expectation is we're going to see a significantly lower growth rate because of this crisis and higher inflation. So which of the two is most keenly impacted will certainly affect how price action goes for the likes of the pound and the euro. In terms of yield, so we've got the 2-year yield here, which essentially is a good proxy for the view over interest rates and therefore inflation expectations. And we can see here that at the top of the stack, we've actually got the Eurozone. So the Euro 2-year up more over the course of this crisis than any of the other majors that we have here. Much of that will be a reflection of the idea, like I said, where previously we thought inflation was going to get down below 1%. Now, all of a sudden, you're seeing the 6-month annualized figure up over 4%. So it's been a massive swing. And that's the change that we're seeing here. It doesn't necessarily mean that they're going to be the hardest hit in terms of inflation than the rest of them, or that we're going to see the most amount of rate hikes from the ECB. But I do think the biggest swing in terms of inflation expectations has come from the Eurozone. And there's a chance that we see the Eurozone raising rates because they've already cut by a significant amount. Now, the UK is second behind that. And so that's probably why you're seeing fairly similar price action across the two. You're not necessarily seeing a major trend for one over the other. If you look over the past month, and bear in mind, we've of course got that outperformance for the Aussie dollar, you can see the Aussie has been climbing pretty significantly of late, but the UK 2-year yield also heavily elevated at the moment as well over the course of the past 2 months. Certainly in terms of rate expectations, you can see here that the view is that from a Bank of England perspective, we're going to see a rate hike in June most likely, but that's a 56.6% chance. July 92% chance. So the strong belief is that we're going to see rates higher, but not necessarily by a huge amount, maybe 1 or 2 rate hikes by the mid part of 2027. And bear in mind, this really paves the way for exactly what I said, the hawkish hold. So the hold is the 86% chance that markets are pricing of a pause. The hawkish side of it is the fact that by July, markets believe there's a 92% chance that we see rates raised. So anything that adjusts these metrics, these expectations, will of course change price action for the likes of the FTSE, the likes of the pound, and alike. From an ECB perspective, the hold is the 76% this time around. So markets less convinced and think there's a greater chance that there's going to be a hike from the ECB at this meeting than the Bank of England. And the hawkish side of thing is the June meeting, which is 77% up to 94% for July. So certainly markets again expect to see rates raised. In terms of looking further out, markets have a greater expectation of a second hike and even a third hike on this occasion. So there is a perception that the ECB is going to go further, most notably or most probably because they've already cut by a more significant amount, so that they're sort of starting from a lower level. So they've got further upside to be able to move into when it comes to rates. So the question mark here really is that's where we are. So markets are already pricing according to these two eventualities. So the question mark is how exactly are we going to see this change for this meeting? And so something to be looking out for is the commentary that comes around this. Bear in mind that BOJ meeting, markets reacted to the vote count, and then it was the comments from UEDA and the presser afterwards that actually sort of cooled some of that hawkishness or some of that upside in terms of the Japanese yen that we had seen originally. So keep a close eye out for the pressers in particular to give us a good idea on whether they are really moving in the direction of a hike or whether they think that this is something that they can look through and look beyond to instead focus on keeping the economy relatively strong. And of course, any adjustments in terms of their outlook for growth and inflation will play into that. Now, from a market perspective, I wanted to start off with gold. And in part, that's because of the fact that if you look at the hourly time frame, this is around the BOJ meeting. And so we did see a ramping up in terms of selling pressure as that hawkish vote count came in for the BOJ. And so, you know, I was doing a video not so long ago and talking about the idea that I saw further upside over the near term as we talk about the possibility of a deal. But ultimately, I think that's going to falter, most notably falter when we see things like higher inflation rates coming out and central banks coming out and saying that they might need to raise rates. That, of course, puts a dampener on sentiment for gold, and certainly things appear to be rolling over at the moment. Now, the caveat to that is it's a question mark on whether we think that this current crisis is actually going to lead us into one hike, that's it, two hikes, and that's it, three hikes, four hikes, five hikes. Do you think it's realistic we're going to see 3 or 4 rate hikes within the cycle? If you do, then there's probably further to run towards the downside from here, and we're going to see a lot of data over the coming month or so, depends how long this lasts, that really does point towards inflation having that second surge, which is all likely to really feed into that narrative around gold weakening, the US dollar rising, and the like. But of course, when we do see that deal, that's likely to provide a spark in terms of gold, pushing it towards the upside. And then, of course, markets are forward looking. So when you start to see adjustments in terms of the 2-year yield, when you start to see shifts in terms of inflation expectations towards the downside, then people start to price for that hump in terms of inflation. So I don't necessarily think that we're now going to see this massive collapse. There is a chance we get back down to the lows of sort of 4,000 because, of course, we've still got a fair bit of data to come from here. But I do think we're moving into, or we will move into, this new phase around here that really starts to provide the new base that's being built before we break higher once again, once inflation is heading lower once again. But I think, you know, inflation undoubtedly is going to be heading higher over the next months or so. And certainly we haven't seen a solution to this at the moment. So the April inflation gauge is going to be very troublesome. And the question mark is, will we see that permeate throughout the economy so that we see core inflation moving higher as well, and not just headline inflation? And that's something that the BOJ came out with. They lifted their core inflation forecast, not just headline inflation. So that means that they expect inflation throughout the economy to rise rather than solely through the energy markets. So yeah, gold at the moment looking like it's going to see further downside to come. And notably, as we saw towards the upside, gradual moves towards the upside. Now it looks like it's much straighter, and in actual fact starting to ramp up in terms of that selling pressure. In terms of the equity markets, in actual fact, let's just jump on to, I'm sure I had the overall view. There we go. So here's an overview. So we've got Europeans on the left, the Americans on the right. And certainly if we were to jump into this from just the perspective where we're looking at, let's just look at the 4 hour actually. So if we're just looking at what's happening in terms of since this crisis began, okay, I stand corrected, better to look on the daily. Here we go. So this is since the beginning of the crisis. So you can see here European markets are down compared to, there you go, you see it from here. European markets are down from the beginning of this. And then most notably, whilst the Dow is pretty much around where it was before, you can see the NASDAQ and the S&P 500 heavily up compared to the beginning of this crisis. And that really shows the influence of the big tech names that have really been leading the way. So European markets do provide the reflection of markets of what's happening in terms of sort of market sentiment as a whole. So if you were to take, say, Brent crude, which we've got here, and you overlay, say, the UK 100 and then the US 100, so the NASDAQ, you look at the hourly time frame. So Here we go. So whilst we've been seeing, let's see, where's Brent? So where we've got Brent crude in the candles, you can see generally what you should generally see is this higher crude leads to weaker equities. And so if I were to invert this, there we go. So this is what's notable, right? So what it looks like is all three of these are correlated, but the difference is I haven't inverted the NASDAQ. So the NASDAQ is moving higher as the FTSE is moving lower alongside the higher oil prices. So higher oil prices should be hurting equities, but it's not hurting US equities, in particular the NASDAQ, which is tech heavy. It would be hurting, say, the S&P 500 if you stripped out tech. So it's different sectors of the US economy that's really suffering at the moment, whereas the UK market certainly is suffering. So you've got that close correlation here in terms of price action for oil and the FTSE 100, but it's inverted. So higher oil means a weaker FTSE, weaker DAX. So let's look in terms of the FTSE first and foremost, and you can see here, much like price action in gold, you can see we saw the rally, the pullback, the lower high being set, and now we're heading lower once again. So certainly, of course, the central bank meetings will play into this, because much of the weakness that we've been seeing in terms of that correlation or inverse correlation with Brent crude is the fact that there's inflation expectations really coming into play here. Higher oil prices means higher inflation expectations, means an expectation of higher interest rates from the central bank. So, of course, when we see these central bank meetings, it's just another part in that chain, right? So if they come out and they're particularly hawkish, then it points towards downside in terms of the FTSE 100. If they come out and say, do you know what, this isn't something we should interject with, it's ultimately oil prices, it will sort itself out, and interest rates aren't going to help with that anyway, then that would likely lift the FTSE 100. But certainly at the moment, much like the price of oil looking like it's just going to continue to grind higher, and how gold looks like it's going to continue to grind lower, so the FTSE 100 is doing exactly the same, so grinding lower. And so I would expect to see more of the same, and unless we saw some sort of major shift, and that major shift could be a deal with Iran. That would be the most significant shift, or that shift could be a Bank of England outlook that is dovish, but I don't necessarily see that happening. I see the hawkish hold coming into play. So that's the FTSE. Here's the DAX, similar kind of thing. I mean, you've got that peak, you've got the sell-off at the beginning of this crisis, the retracement. Now we're rolling over once again. Here's the hourly time frame, and you can see here we've got that gradual move lower, but largely sort of flatlining at the moment, not necessarily seeing a very convincing sell-off over the course of the past week. So it's not necessarily sort of collapsing exactly. It's sort of seen that drop and now sort of consolidating at the moment. So look, ultimately, a lot of this is going to be guided by what happens in terms of oil prices, as we've seen, because of that close inverse correlation. But also when we come into these interest rate decisions, if we do see particularly hawkish outlook coming into the fold at a time where we're seeing rising oil prices, it just sort of doubles down on that narrative around the idea of higher interest rates, and therefore weaker equities within the region. And finally, let's look at euro sterling. We can see here that we've been sort of moving higher over the course of 2025 as we move towards that rate cut and that phase of rate cuts from the Bank of England. Well, they're not necessarily going to continue, because the view that we're going to see a collapse in terms of inflation that I've been talking about for the best part of a year, well, that's being overshadowed by the surge in inflation coming from the Iran crisis. And so we've seen a pullback. Once again, we're in trendline support at the moment. Do we see a strong move towards the upside from here? Certainly, like I said, the ECB at the moment, markets are pricing a greater chance that we see a rate hike this time, a greater chance that we see a rate hike at the meeting after this, and a greater chance of a more significant amount of hikes over the course of the next year and a bit. But really, it's about adjustments in terms of expectations as well, rather than what it's currently stating, because that's currently what's being priced into the market. So if we see the ECB coming out with a pretty hawkish statement, that could provide the basis for a potential low to come into play here for euro sterling. Watch out in particular for resistance up ahead. If we do see that surge, you'd need to see a break up through the 0.874 to signal the bottom following this pullback, because at the moment the trajectory still does point towards downside. If we look at, say, the 4-hour chart, you can see here that relationship between the European 2-year, the EU 2-year, and the GB 2-year. Pretty close correlation at the moment. So it's not like the yields at the moment are signaling that we should be doing anything different from what we're seeing at the moment. So yeah, the trajectory on yields is being followed well by what's happening in terms of the FX perspective, but there is a good chance that we do see a relatively hawkish view from the likes of the ECB, providing the basis for a potential rebound here for euro sterling. But I would say at the moment, you know, it's quite difficult to know exactly what's what from an FX perspective. I'd say probably the clearer pictures are in oil at the moment, but then you've got the risk in terms of any Iran news that might get leaked. Gold, I mean, look, quite frankly, you've got the risk of major leaks or announcements for any of these markets that are going to impact them quite significantly because of what's happening in Iran. It's a funny old time to be trading in the markets. Major volatility, but a lot of it is news driven, which can provide for a rather jittery market environment to trade within. I hope this video has been useful. Make sure to like, subscribe, and follow for more. My name's Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.